perhaps there will be greater access to private companies that we're reading about in the news. To be clear, there's still no guarantees in these investments. We're still playing a startup investment game here to some degree with these companies, right?
Things can still go very wrong.
Things can still go very, very wrong.
Hi, this is Matt Cocker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. This week we're going to talk about a really interesting acquisition that happened last week, which was the Morgan Stanley purchase of EquityZen. EquityZen is a platform that allows early employees or other shareholders of private companies to sell their shares to interested investors, accredited investors. And I thought this was a really interesting acquisition that to me was not one that I had seen coming. Wendy, I'm curious your general take here.
I think it speaks to the ongoing interest in private market companies. We've talked a lot about how private market companies, VC-backed companies, are staying private for longer and generating a lot of growth and revenue and yet continuing to stay private. And I think there's just this enormous demand, pent-up demand for access to these types of investments. And so I wouldn't have expected it either, but now that it's happened, to some extent, it makes a lot of sense. I think what's actually more interesting is even just the evolution of how these secondary markets have developed and how it has become even possible at all today for investors to go onto a marketplace and potentially, again, without speaking to the types of companies or which companies are on these platforms, but even to be able to purchase shares of private companies is a remarkable, mark of progression. And I think you, Matt, having been in these markets for a long time, having been a founder who owned private shares of your own businesses and your own companies, and having many peers and colleagues in similar places, many founders that I think, you can probably speak a lot more to just how far we've all come to be at this place where a platform, a marketplace like EquityZen is going more or less mainstream with Morgan Stanley.
Yeah, it has been quite an evolution. When I started my first company back in 2002, there was really no path to liquidity for a founder, for an early employee, until some kind of exit, whether it was an M&A or an IPO. And typically when you receive shares of an early stage startup, there were a whole bunch of restrictions that you had on those shares. That the most common restriction at the time was that if you wanted to sell your shares, the company had a right of first refusal. But it was incredibly uncommon for early employees or founders to be able to go sell their shares outside of an IPO or an M&A. And actually, over time, those restrictions got often even tighter. Uber was one of the first to actually just place a blanket restriction on transfer of shares. They didn't want employees to be able to go sell to essentially random people that Uber didn't want on their cap table. And it's kind of understandable, right? You don't want a bunch of shareholders you don't know, you have no control over. When it comes time for a vote, how do you even find them, etc. What did happen in the early teens was it became more common for investors to start giving founders and early employees the option to get some liquidity in a managed process when new capital was raised. So, typically this would be at Series B, Series C, and beyond. An investor would come in, would purchase new preferred shares in the company, but would also offer those founders, those early employees, some opportunity to sell some portion of their equity holdings, often call it up to 10%, in a secondary transaction.
And to be clear, this was not a frequently used option prior to that period.
No, very, very infrequent, right? It was seen as you were in it for the long haul. You were stuck with the company and you were stuck with those shares until there was some liquidity event. But I think that what happened was a lot of investors recognized that, particularly for founders, who essentially a big chunk of their net worth, at least on paper, was tied up in these companies, that it was helpful to give these founders some bit of escape valve in some sense, like let them go buy a house or get out of eating ramen every night and go have a little liquidity, not enough to where they weren't motivated to go continue to build the company, but at least enough that they could stop worrying about how they were going to support their families. But again, these were all typically very managed transactions in the context of an equity fundraise, typically led by a sophisticated venture investor. The model that EquityZen, and they're not alone in their model, is kind of this next evolution, right? Which is not that we're only going to allow, or the companies are only going to allow employees to sell shares during priced investment rounds, but they're actually going to create this marketplace that potentially allows an employee or a founder or even an early investor in the company to go sell their shares when they want to a willing buyer. And in some sense, I think to try to make private secondary markets look more like public markets, where there's buyers and sellers and they can come together on, in some sense, an exchange. And so it's a really interesting development in this kind of, I guess you could say, democratization of private markets.
Okay, so let's go a level deeper and talk about the mechanics of how this actually works. What does it look like to have that transaction take place, a secondary transaction from an employee to an outside investor, within maybe putting aside, the Series B, Series C, VC investors coming in and purchasing as a secondary purchase from early employees and founders, putting that aside? What do the mechanics look like for these platforms then, for an EquityZen, for a Forge, or other competitors?
They've actually evolved over the years, which is interesting. So in the early days of these platforms, often these were platforms that were simply facilitating essentially person-to-person sales, where you as an early employee would say, I want to sell. The platform would identify an accredited investor on the other side, and they would facilitate essentially a private transaction that sometimes in some of these platforms, these were approved by the companies. Other times there were platforms that tried to come up with interesting structures that involved things like forward contracts, or others that didn't necessarily require, or they perceived didn't require, the approval of the company. But I think what we've seen over the last 5 years is the space has matured, and how most of these transactions now are being structured are via SPVs. And we've talked about SPVs on a previous episode. But essentially, these sales are happening in an approved way. The companies are typically involved in approving these transactions.
To be very clear, when we talked about SPVs in I think it was our first episode actually, we were talking about these multi-layer SPVs where a lot gets lost in translation, including ownership rights, voting rights, right, where the company maybe does not even approve of that transaction. Like, this is different. The SPVs we're describing here are different.
Yes, this is all actually, I would say quite transparent. And certainly the issuing company, the startup here, is involved in these transactions, and they understand what's happening. And so the typical structure here is that EquityZen, for example, will set up an SPV to purchase shares from employees or early investors in the target startup. And then the EquityZen customer, the end investor here, is purchasing equity shares in the SPV. And so this has the benefit, first of all, for the company, the startup, that they don't have a bunch of random people on the cap table. The entity on the cap table is EquityZen, and there's a relationship there, and they know who to call when there's a shareholder vote or they have a question. But it's also actually good for the end investor in some ways, because, for example, one of the things that EquityZen offers in certain cases is for the ability for the EquityZen customer who has purchased shares in this SPV to go sell their stake to another EquityZen investor who can essentially purchase their stake in the SPV. And what's nice there is the company doesn't even have to be involved in this at all, because you're not transacting in shares in the company, you're just transacting in shares in the SPV. And so I think it's a structure that makes sense for everybody involved. But to your point, it's not one of these multi-layer SPVs. It's a single-layer SPV, and there are fees, and you're paying EquityZen for the right to do this. But I think it's all quite transparent.
And to be fair, I think this is where the partnership, the acquisition by Morgan Stanley, is actually likely to lead to benefits on both sides, the investor side and the company side, because I think one of the areas where there was potentially slippage at EquityZen and like platforms, so this is not specific to any one platform. That I'm not picking on anyone here. But I do believe that there were moments where there was a matchmaking uncertainty, meaning that the platform, EquityZen, for instance, might be aggregating potential investor interest and holding on to those dollars while they were on the other side having conversations with the company, trying to negotiate a transaction in place to create that SPV, to negotiate for those transfers of those shares. And sometimes it just didn't happen. And so you would have investors who might be planning to or have already earmarked and sent dollars into the platform, expecting to then receive ownership, indirect ownership through this SPV into these companies that just didn't materialize. And to be fair, there's no wrongdoing here. Everyone got their dollars back, but I think there were moments of uncertainty when that matchmaking might happen before the SPVs were solidified. And I think this is actually one of the areas where, as a standalone platform, that risk was probably greater. And I wonder if now that there's this acquisition and partnership with Morgan Stanley, maybe that de-risks some of that, where there is, I could imagine increasingly that there will be fewer of those where the transaction doesn't occur and there was not certainty of execution before investor dollars were aggregated. This is me speaking hypothetically, right?
I think you're right. Because I think one of the tricky dynamics here, if you are a platform like EquityZen or Forge or one of these, is that there's not a lot in it for the company, for the startups to do this, right? Like the startups are not getting anything out of this other than, it's a way to potentially improve employee satisfaction. Although in a lot of cases, which is a big deal, right? But right. Although in a lot of cases, right, like I would suspect that a lot of sellers here are former employees, not necessarily even current employees. So then there's really nothing in it for the company, right? And so I think, knowing that the firm on the other side of this transaction is Morgan Stanley, not a startup themselves, and this is not taking anything away from EquityZen, but they're a 50-person company. They're not Morgan Stanley. I think for a startup now, knowing that it's Morgan Stanley on the other side, to your point, with a lot of liquidity and also a lot of other services they can offer you as a startup, and Morgan Stanley talks about this in their press release, that this is part of a broader strategy of theirs to provide a range of services to startups and startup founders. Knowing that it's Morgan Stanley on the other side, I think, is likely to encourage more startups to take advantage of this kind of platform and this kind of offering, which is good for everybody, right? It does create more liquidity for early employees, which is great, right? I think it's broadly good for startup employees and early investors to have more liquidity options. And I do think that for sophisticated investors on the other side, and in Morgan Stanley's case, who are probably almost certainly working with sophisticated financial advisors, to have this as an option in their portfolio.
Yeah, absolutely. I mean, I think we talk a lot about the evolution of private markets, about how private companies are staying private longer. And so it becomes, as we said at the outset here, there's all this pent-up demand, recognizing that value creation is happening, and yet individual retail investors don't necessarily have access to capitalize on that value creation, to participate in the value creation as companies continue to stay private longer. The idea that here's a platform that could provide, with Morgan Stanley's partnership and ownership, could provide a broader access point, because it might solve for some of the challenges that as a standalone platform were harder for individual investors to get over. Maybe this starts to create some sort of template for how this could work and how others might follow in providing access to these types of companies. Now, ultimately, it still so very much depends and hinges on which are the companies that are going to participate and at what valuations will they participate, and how will these SPVs be struck, and how will participants and buyers and LPs in these SPVs, how will they be treated, and how will their stakes be valued, and what will their transfer rights be in the SPVs. And so there's still lots of outstanding questions, but at least there is some sort of a template for perhaps there will be greater access to private companies that we're reading about in the news, companies that are showing evidence of tremendous growth and are attractive and compelling for individual investors, which is not to say, to be clear, like there's still no guarantees in these investments. We're still playing a startup investment game here to some degree with these companies, right? Like
things can still go very wrong.
Things can still go very, very wrong, right? So it should not be viewed as, I don't know how many companies are on the platform, but it should not be viewed as these are however hundreds of companies that are going to all be successful outcomes. The number and the ratio is probably still significantly below 50-50 in terms of ratio of success, but at the very least, there's pathways to those companies that might be outliers and huge outlier winners, whereas before there wasn't. So I think net I still view this as being a big positive, a big milestone for the market. It's indicative of both what demand looks like for investments into these types of privately held companies, and then at the same time, like I said, it's a template for how this might look for other participants going forward.
On the flip side, as we think about net negatives, I wonder if, going back to an earlier conversation we had in a previous episode around the lack of incentive for companies to go public and for investment opportunities to be available to non-accredited investors who, right, EquityZen is not available. These platforms are not available to the average investor, right? You have to be a relatively affluent, high net worth person to get access to these. I do wonder if this just removes yet another reason for companies to think about going public, right? To the extent that historically companies went often public because they needed capital, and we've talked about how that has become less pressing given the amount of capital that's been available for businesses raising capital in the private markets. But another reason, certainly, for companies to go public was to create liquidity for early employees, for early investors. And now you're removing that pressing need.
Okay, but
and so
I'm not sure. I'm a little bit less concerned about, actually, I think having Morgan Stanley be on the other side of this, in fact, is maybe one of the benefits of this is that there is going to be a light at the end of the tunnel at some point in the future, because Morgan Stanley is an investment bank. Like, they are the book runners for IPOs, right? Like, they have a lot of incentive on the other side of the house to encourage these companies that might be on this platform to then consider an IPO with Morgan Stanley as the book runner, right? And they're transferring that illiquidity from early employees and founders, but they're transferring it potentially to their own clients. And so I think the incentive is actually there in a way that maybe it wasn't before.
They're playing a long game.
Exactly, to create IPO liquidity. And I think the likelihood is actually ever so incrementally increased that these companies might actually IPO.
Yeah. They're going to have more tentacles into every aspect of these private companies. So actually, I'm curious, as an institutional investor, how you think about this. Do you think this has any impact on ultimately how institutional investors get access to private companies, or is it just a different world?
I think it's much more the latter. So institutions are going to be typically the LPs and investors and those sophisticated VCs that are funding these companies at various stages, whether it's early stage through Series B, C, later stages. The institutional investors are predominantly going to be LPs in these VC firms, and then to the extent that these VCs in the later stages have, we talked a little bit about this, co-investments into companies as their later stage and have more capacity rights than they might take down into their own fund. Maybe an LP participates into a co-investment in some of these companies as their later stage. That's really, I think, from an institutional investor standpoint, continues to be how they invest in these companies. There's going to just be more direct investment and transparency. I think that there is a parallel world here for individual investors. I do think, broadly speaking, institutions will always have a slight leg up in terms of how they're accessing these companies as primary investors. They're not likely to be as involved in that secondary investment, company investment ownership. There's a terrific argument to be made that market should exist. I believe it should exist. And so I think that, again, they're just parallel worlds where I'm not sure that institutions will play as much in that secondary equity piece for individual companies. because they have so much more involvement in that primary investment space as LPs of VCs.
And I guess this also goes back, thinking about the leg up, right? I think one of the other interesting questions and where things can go wrong potentially for folks that are purchasing shares on these platforms is the kind of shares that venture capital firms are typically purchasing or LPs are purchasing if they were coming in to co-invest, right? Like often those shares have different rights, different preferences. When everything goes well and there's an IPO, none of that really matters. But if things don't go as expected and a company sells for less than its last valuation or there's some kind of transaction, right? Like those rights and those control provisions can really matter.
Mm-hmm. Yeah, those liquidation preferences are going to favor, you're right, the primary investors who are negotiating the terms on those investments. I do think, yes, that will continue to be a distinction. And I would imagine that's one of those, if you continue to look and poke around, there will be other distinctions, and they're not perfect apples to apples. And to be fair, I don't think investors who are coming into a platform to be a secondary buyer, to engage in one of these transactions with an employee perhaps on the other side who's selling their shares, I would think and I would hope that investors who are engaging in that transaction realize that, right? I would hope that investors recognize they're investing at slightly different terms and that the investment here is really for an upside scenario and that there aren't as many downside protections and risk controls, which, to be fair, should always be somewhat the expectation when it comes to venture investing.
Yeah, at the end of the day, this is venture investing. Well, I think we can both agree that ultimately opening up private markets access to more investors done well is a net positive, and so I'm excited certainly to see how this acquisition matures and what follow-on activity we see. I suspect this will not be the last we see in the market of large traditional asset managers getting more active in private market secondaries. Well, thanks for joining us this week on the Investment Office. We'll see you next week.